Picture this. You're sitting in a beachside cafe in Bali, laptop open, earning $150,000 a year as a freelance developer. Your clients are in New York, London, and Singapore. Your income tax bill? $0, €0, zero anything. This isn't a fantasy. Right now, an estimated 40 million people around the world are doing exactly this, working remotely from countries that don't tax their foreign income. They're not breaking any laws. They're not hiding money in offshore accounts. They're playing a game, one that most governments design themselves. This is the story of how digital nomads legally pay zero tax, and why the window to do it is rapidly closing. Here's something most people never think about. Governments don't tax you based on what you earn. They tax you based on where you live. This is called residency-based taxation, and it's how nearly every country on Earth works. If you're a tax resident of the United Kingdom, you pay UK taxes, even if your income comes from a client in Tokyo. If you're a tax resident of Germany, you pay German taxes, even if you never set foot in a German office. The critical word is resident. And here's where digital nomads found their edge. Tax residency is determined by physical presence. In most countries, the threshold is 183 days. Spend fewer than 183 days in a country, and you're generally not considered a tax resident. So what happens if you spend fewer than 183 days everywhere? In theory, you become a tax resident of nowhere. Your income floats in a legal gray zone, technically earned, but with no country claiming the right to tax it. Now, this sounds like a loophole, and in many ways, it is. But some countries have turned this gray zone into an explicit invitation. In the 1960s, an investment newsletter publisher named Harry Schultz came up with an idea he called the three flags theory. His concept was simple: spread your life across multiple countries so that no single government can control you. By the 1990s, author W.G. Hill expanded it into the five flags theory in his book, P.T. Perpetual Traveler. Today, it's the blueprint for how digital nomads structure their lives. Flag 1, citizenship. Hold a passport from a country that doesn't tax worldwide income. Paraguay, Panama, and several Caribbean nations offer this. Flag 2, tax residency. Establish your official tax home in a zero-tax or territorial tax country. The UAE, Panama, and Paraguay are the most popular choices. Flag 3, business base. Incorporate your company where corporate taxes are low and banking is accessible. A Wyoming LLC in the United States costs $300 to set up and pays zero federal tax on foreign income. Flag 4, banking. Keep your money where it's protected and globally accessible. Singapore and Switzerland remain the gold standard. Flag 5, playground. Live where the quality of life is high and the cost of living is low. That's why you'll find so many digital nomads in Thailand, Bali, and Lisbon. The modern version? Paraguay residency plus a Wyoming LLC plus a Singapore bank account, all while living between Southeast Asia and South America. Effective income tax rate, 0%. Let's start with the most obvious play, countries that charge zero income tax. Period. The United Arab Emirates is the crown jewel. Dubai alone hosts over 100,000 remote workers, attracted by zero personal income tax, a one-year renewable remote work visa, and world-class infrastructure. The catch? You'll need to prove at least $3,500 per month in income, and the cost of living runs between $2,500 and $4,000 per month. In 2023, the UAE introduced a 9% corporate tax on profits above $102,000, but individuals earning a salary or freelance income remain untaxed. The Bahamas offers a similar deal: zero income tax, zero capital gains tax, zero corporate tax. Their BEATS program gives you a one-year residency for remote work, though living costs hover around $3,000 per month. Then there's Monaco, the most exclusive zero-tax jurisdiction on Earth. No income tax since 1869, but residency requires significant wealth, and the cost of living is legendary. A one-bedroom apartment averages $4,500 per month. Bermuda takes a different approach. Their Work from Bermuda program requires a minimum annual income of $100,000. In exchange, You pay zero income tax on everything you earn. The trade-off across all these havens? Your trading tax savings for a higher cost of living. A digital nomad earning $150,000 might save $40,000 in taxes, but spend an extra $20,000 on rent alone. But here's the strategy that most digital nomads actually use. It's not moving to a zero-tax country. It's moving to a country with territorial taxation. Territorial tax systems only tax income earned within their borders. If your clients are overseas and your money comes from abroad, you own nothing locally. Panama is the gold standard. Its territorial tax system is written directly into law, not administrative practice, not a loophole, but codified legislation. A digital nomad visa requires $36,000 per year in income. The country uses the US dollar, eliminating currency risk, and residency is available through the Friendly Nations visa for citizens of over 50 countries with just a $5,000 bank deposit. Paraguay might be the most affordable option on earth. Temporary residency costs roughly $2,500 all in. You only need to visit once per year to maintain it. Foreign income is completely untaxed. And after 3 years, you can apply for citizenship, a second passport from a country with zero worldwide taxation. Then there's Georgia, which until recently was the digital nomad's dream. Visa-free entry for 365 days. A 1% tax on turnover up to $165,000 through their small business status. But in June 2025, Georgia passed new legislation requiring work permits for foreign nationals starting March 2026. The unregulated era is ending. Costa Rica deserves special mention. Their digital nomad visa explicitly exempts foreign earnings from local taxation, and holders are not considered tax residents even after 183 days. That kind of explicit legal protection is rare and valuable. The 183-day rule sounds simple. Spend fewer than 183 days in a country, and you avoid becoming a tax resident. But the reality is far more dangerous than the theory. The United Kingdom uses a statutory residence test, where as few as 46 days can trigger tax residency. If you maintain 3 or more ties to the country, like a home, a spouse, or a job. France and Spain can claim you as a tax resident based on your center of vital interests, meaning if your family or your primary business is there, the day count doesn't matter. Germany's rules are similar. Maintaining a rented apartment can trigger residency even if you spend fewer than 183 days in the country. And then there's the United States. America is one of only 2 countries on earth that taxes its citizens on worldwide income regardless of where they live. A US passport means the IRS follows you everywhere. The foreign earned income exclusion lets you shelter up to $132,900 in 2026. But only if you qualify through genuine overseas residence or the physical presence test. Here's the thing most people miss. Being a tax resident of nowhere sounds clever, but it's legally risky. Many countries can still pull you into their tax net through tiebreaker rules, and being stateless for tax purposes can trigger audits, lose you banking access, and create problems you didn't see coming. The vehicle most digital nomads use to earn income isn't a personal bank account, it's a company. And where you incorporate that company matters enormously. The most popular option is a Wyoming LLC in the United States. It costs about $300 to form and $60 per year to maintain. If the owner is a non-US tax resident and the company earns no US-sourced income, the federal tax rate is 0. You'll need to file IRS Form 5472 annually, and the penalty for failing to file is $25,000. But the filing itself is informational only. No taxes owed. Estonia's e-residency program was revolutionary. Over 120,000 digital identities issued, 33,000 businesses created since 2014. An EU-based company, managed entirely online, with zero tax on retained profits. But in August 2025, Estonia quietly stopped issuing EU VAT identification numbers to residency companies. Without a VAT ID, invoicing European clients becomes problematic. The program may no longer be viable for nomads serving the EU market. The UAE free zone model remains strong. Setup costs range from $1,400 for budget-free zones like IFZA to $8,000 for premium options like DMCC. Free zone companies can maintain a 0% corporate tax rate on qualifying income, but substance requirements are real. You need a physical presence, genuine business activity, and local decision-making. A mailbox company won't survive an audit. If you're just starting out, the Wyoming LLC is the path of least resistance. $300, zero tax, and you can open a U.S. bank account with Mercury or Wise Business using just your EIN. It's the single most cost-effective structure for location-independent income. Here's the part nobody wants to hear. The strategies that worked between 2020 and 2023 are being systematically dismantled. In January 2024, Thailand closed its famous remittance loophole. Foreign income sent to Thailand is now taxable for anyone spending more than 180 days in the country, regardless of when that income was earned. In August 2025, Estonia effectively killed its e-residency advantage for digital nomads by freezing VAT ID issuance. In November 2025, the OECD updated its permanent establishment rules for the first time in a decade. The new framework introduces a 50% working time benchmark. If you work more than half your time from a single country, your employer or client could face tax obligations there. And starting March 2026, Georgia will require work permits for foreign nationals doing any paid work, freelancing included. The era of showing up with a laptop and paying 1% tax is over. Behind all of this is the OECD, the Organization for Economic Cooperation and Development. They're actively pressuring territorial tax countries like Panama, Paraguay, and Georgia to adopt worldwide taxation. The Pillar 2 Global Minimum Tax, a 15% floor on large multinationals, signals the broader direction. The number of countries offering genuine zero-tax structures to digital nomads is shrinking. Not disappearing, but shrinking. Panama and Paraguay remain strong. The UAE remains viable. Costa Rica's digital nomad visa is explicitly protected. But the trend is clear. International coordination is closing loopholes faster than new ones open. And then there are the traps that catch even experienced digital nomads. Controlled Foreign Corporation Rules, or CFC rules, are the biggest one. If you're a tax resident of the US, UK, Germany, France, Australia, or Canada, your government can tax you on income held by foreign companies you control, even if you never take a dividend. A U.S. citizen who forms a UAE free zone company still owes American taxes on that company's income under the GILTI provisions. The only true defense is establishing tax residency in a country without CFC rules, which brings us back to Panama, Paraguay, the UAE, Georgia, and Hong Kong. Permanent establishment risk is another trap. Working from a single country for extended periods can create tax obligations for your clients. If a French company's star developer works remotely from Portugal for 8 months, Portugal may argue that the French company has a permanent establishment there and demand corporate tax. And then there's substance. The word every tax advisor repeats. Your offshore company needs real employees, a real office, and real business activities in the jurisdiction where it's registered. A $60 per year Wyoming LLC works perfectly, as long as you're genuinely a non-US person earning non-US income. The moment an audit reveals a shell with no substance, the entire structure collapses. So here's the honest answer. Can a digital nomad legally pay zero tax? Yes, but it requires structure, planning, and professional advice. The simplest legitimate setup looks like this. Step 1. Establish tax residency in a territorial tax country. Panama and Paraguay are the strongest options. Step 2. Form a business entity in a zero-tax jurisdiction. A Wyoming LLC for most people. A UAE free zone company if you want to be based in the Gulf. Step 3. Bank where your money is safe and accessible. U.S. business banking through Mercury or international through Singapore. Step 4. Stay compliant. File every form. Meet every deadline. Keep records of your physical presence. The $25,000 IRS penalty for a missed Form 5472 will wipe out years of tax savings. The 40 million digital nomads working around the world today are proof that this model works. But the 2024 The 2026 regulatory wave is proof that it won't stay easy. The countries that still welcome location-independent workers are valuable and getting rarer. If you're serious about this path, the time to act is now, not next year. Now. Which strategy would you actually use? Territorial taxation in Panama or the zero-tax lifestyle in Dubai? Drop your pick in the comments. And if you want to understand how the world's biggest companies play this same game at a billion-dollar scale, watch our video on how Amazon paid zero tax on $35 billion. Subscribe to TaxMap so you never miss a strategy that could save you thousands. See you in the next one.